Okay, we are looking at M4-5, which is on page 176 of the Phillips textbook. 4-5 says, for each of the following transactions for the Sky Blue Corp, give the accounting equation effects of the adjustments required at the end of the month on December 31st, 2012. Well, since you have the solutions to that already, I thought what I'd do for 4-5 and 4-6 here is book the journal entry as it's stated on December 1st in 4-5, and then book the adjustments in 4-6. So the first one says collected $2,400 rent for the period December 1st, 2012 to February 28th, 2013, which was credited to unearned revenue on December 1st, 2012. So they kind of gave away with that last part there, what we're booking here on December 1st. But if we back up for a second, we're collecting $2,400 in cash for rent for a 3-month period, December, January, and February. So on December 1st, we would want to book an increase to cash for that full amount. And at this point, we have not provided any rental space, right? We're being paid in advance for 3 months. So we're going to book the entire amount to unearned rent. Again, our unearned accounts are liabilities, right? We're being paid in advance for some service or good we're providing in the future. So we're increasing our liability by $2,400. Nothing happens to the income statement. On our balance sheet, our assets and liabilities have both increased, so we're still in balance. And on the statement of cash flows, we consider this an operating activity. Letter B says that we paid $1,200 for a 2-year insurance premium on December 1st, 2012. And I'll skip that second part of the statement there because it's just telling us the account to use. So again, we're paying in advance this time for a service that we're going to be provided with by the insurance company. So all of our prepaid expenses we book as assets upon that initial purchase. So here we've got prepaid insurance, again something we own for the time being, it's providing us some future benefit. $1,200. Keep in mind that's for 2 years, so that's $50 per month. And we're paying in cash presumably. So we'll decrease our cash account for the same $1,200. Nothing's happened on the income statement here. On the balance sheet, our assets have moved up and down in the same amount. And on the statement of cash flows, we do consider this an operating activity. It's generally only fixed assets like property, plant, and equipment that we would consider an investing activity. Letter C says that we used a machine purchased on December 1st, 2012 for $48,000, and the company estimates annual depreciation of $4,800. So here on December 1st, when we actually purchased that machine, keep in mind that we'd be increasing some equipment asset account for $48,000 and presumably decreasing cash in that same amount. Let's assume we paid cash for it. Again, no income statement effect. Assets have moved a net of 0, and this would be considered an investing activity on the statement of cash flows. So that's really 4-5. So 4-6 wants us to actually prepare the adjusting entries for December 31st. See the end of that month. So I'll put adjustment A. And if we look back to transaction A from the previous problem there, we had received $2,400 in rent for a 3-month prepaid rent contract. So now 1 month of that has gone by. We have earned, in effect, 1/3 of that amount. So what we do is we decrease our unearned rent account by 1/3 of that amount. And now we can recognize earned revenue for that same amount. So to increase the revenue account, we need to debit it, or credit it, excuse me. On the income statement, our revenue now has increased, so our net income will increase. Liabilities have decreased, and our stockholders' equity has increased, so we're still in balance, and no cash has changed hands. For the adjustment for letter B, if we'll recall from a moment ago, B was our purchase of 2 years worth of prepaid insurance. So now 1 month of that contract has expired. We've used up 1 month's worth of coverage. So I can recognize 1 month worth of insurance expense. So I want to increase the insurance expense account by $50. And I want to decrease that prepaid insurance account. I'm in essence kind of burning off this prepaid insurance. I had $1,200 worth at the beginning of December when I purchased the policy. Now I've got $50 less worth going forward. I've used up 1 month. Expenses have increased, so net income will decrease. My assets have decreased, and my stockholders' equity will decrease via that decrease in net income. Again, no statement of cash flow effects. Remember, our adjusting entries will never have cash in them. Okay, they're only booked because we're using accrual basis accounting, so we won't ever have cash in any of those transactions. We have one more, that's adjustment C. So C was our purchase of equipment at the beginning of December. Now we're going to recognize an adjustment for the depreciation on that machinery. So we purchased it on December 1st, we're at December 31st. So we can recognize depreciation expense. We're going to increase that expense account. It told us that annual depreciation was $4,800. So really I just want 1/12 of that for the month of December. So $400. My credit, remember, is not directly to that equipment account. It's to the accumulated depreciation account, which is a contra asset. So we're increasing that with a credit by the same amount. Here our expenses have increased again, so my net income will decrease. My assets now have decreased because my contra asset, which offsets my assets, have increased. My stockholders' equity decreases as well. And again, no statement of cash flow effects. And that's it for my adjustments for 4.6. Okay, now we're looking at M4-10, which tells us that for each of the following independent situations, we need to prepare journal entries to record the initial transaction on December 31st and the adjustment required on January 31st. So for these, we'll do them back to back. We'll do the initial entry in December and then immediately after the adjustment for January. So letter A says that Magnificent Magazines, we'll assume that's kind of us, received $12,000 on December 31st for subscriptions to magazines that will be published and distributed in January through December of 2014. So on December 31st of 2013, when we received that influx of cash, we need to increase our cash account with a debit in the amount of $12,000. And again, if we think back to our revenue recognition principle, we haven't earned anything yet. We haven't published any magazines. So what we need to book is unearned, we'll call it unearned subscription revenue. It's a liability, right? We owe subscription services to our customers. So we need to credit that for $12,000. Nothing's happened on the income statement. On the balance sheet, our assets and liabilities have both increased. And on the statement of cash flows, we'd record this as an operating activity. So the adjustment at the end of January needs to take into account the work we've done, the subscriptions we provided for January. So we received payment for 12 months worth of subscriptions for $12,000. So that means each month's worth is $1,000. And at the end of January now, we would have earned $1,000 worth of that revenue. So what we'll do each month is book a decrease to the unearned subscription revenue account, debiting it for $1,000 and crediting subscription revenue. That's a revenue account, so again we're increasing that with a credit. We're saying now we've earned 1/12 worth of those subscription fees we were paid in advance for back in December. When I book this transaction, my revenues have increased, so my net income will increase as well. My liabilities, decrease, and my stockholders' equity increases via that increase in net income, and no cash has changed hands. So here on January 31st, I need to record revenue that I've earned in the amount of $1,000. So I will decrease that unearned subscription revenue account for the amount of $1,000. And I will now recognize earned revenue, subscription revenue, for the same amount. So I'm increasing my revenue account by $1,000. From an income statement standpoint, my revenue has now increased, which will increase my net income. My liabilities have decreased, my stockholders' equity has increased, so I'm still in balance on the balance sheet, and there was no cash effect. Letter B says that Walker Window Washing paid $1,200 cash for supplies on December 31st, 2013. So we'll stop right there and book that transaction. I purchased supplies. Supplies are an asset, right? Something we own and we'll get some benefit from. That was for $1,200. I paid cash, so I need to decrease my cash account by that same $1,200. When I book that transaction in December, nothing happens for my income statement. On my balance sheet, my assets move in opposite directions here. And we'll consider that an operating outflow on my statement of cash flows. My adjustment then at January 31st, we need to go back to our description, which tells us that as of January 31st, $200 of these supplies had been used up. So the amount that I've used is the amount I need to record as supplies expense for that period of January. So here I say supplies expense. It's an expense account. I'm increasing it by the amount I've used up in supplies, $200. And now I need to decrease my supplies account by that same amount. So my balance in the supplies asset account needs to drop down to $1,000 to reflect what's left over, what I have not used up. So this transaction, when I book it, increases my expenses, which decreases my net income. My assets have decreased, my stockholders' equity will decrease, and no change in cash. One more here, we have letter C, which says Indoor Raceway received $3,000 on December 31st, 2013 from race participants for providing services for 3 races. One race is held January 31st, the other 2 will be held in March. Okay, so on December 31st, we've received $3,000 in cash. So I know if nothing else, I need to increase my cash account by $3,000. Well, why'd I get cash? Well, I was paid in advance for future services. So again, we've got some unearned revenue. Doesn't matter what we call that as long as we have those keywords in there. Unearned race revenue would be okay as well. Any unearned revenue account's a liability. So we're increasing that with a credit, $3,000. No income statement effect here. I'm only changing assets and liabilities. On the balance sheet, my assets have increased, as have my liabilities. And on the statement of cash flows, we consider that an operating activity. So now my adjustment at the end of January. On January 31st, we hold one of the 3 races. So now I've, in effect, earned 1/3 of that revenue. So I can decrease my unearned revenue account by debiting it for $1,000. That's 1/3 of the original amount. And I want to recognize some revenue account, we'll call it service revenue, for that same amount. Again, got paid in advance on December 31st, but I can't recognize revenue because I haven't done any work. Now I've done some work, I've run one of the races, so I can recognize revenue for 1/3 of that original amount. Here my revenue has increased, so my net income will increase. My liabilities have decreased, my stockholders' equity increases, so we're still in balance on the balance sheet. And nothing has happened on the statement of cash flows. Thus ends 4-10. Okay, now we're looking at M4-17, dealing with closing entries. So 4-17 says refer to the adjusted trial balance in 4-14, and that's on the previous page in your text. We want to prepare closing journal entries on December 31st, 2012. Well, if we think for a second what accounts we need to close, we need to close all of our temporary accounts. Temporary accounts are anything that's not on the balance sheet, right? So that's our revenue accounts, our expense accounts, and any dividends we may have. If our trial balance is in the correct order, and the trial balance in 4-14 is, we'll find all of our temporary accounts below our stockholders' equity accounts. So if we look, our last stockholders' equity account is retained earnings at $1,000. So everything below that we need to close. So dividends is listed first. So let's start with that. Dividends has a debit balance of $300. So to close it, I need to credit it for that exact same amount. So dividends is a contra stockholders' equity account. We are in fact decreasing it because we're closing it. So we're going to credit it for $300. And we need to debit retained earnings, which is a stockholders' equity account, thus decreasing it for that same $300. So again, with our closing entries, what we need to do is get all of those temporary account balances to zero and close the effects of those accounts to our retained earnings permanent account. So I've done that here for dividends. Close dividends to zero, move it or close it out to retained earnings, same amount. We don't really need to look at the financial statement effects of our closing entries because again, we're just moving those temporary balances to our permanent accounts. So I've gotten rid of dividends here. Next up, I have my revenue accounts. So my sales revenue has a credit balance of $42,030, my rent revenue of $300. So to close those, I can debit them for the amount we see there. So sales revenue, I'll debit for $42,030. And then rent revenue, I will debit in the amount of $300. Again, I'm always closing my temporary accounts to retained earnings. This time I'm closing my revenue accounts, so that will have the effect of increasing retained earnings. And then it's just the total of those two accounts, $42,330. Finally, we have our expense accounts. Wages expense, depreciation expense, utilities expense, insurance, rent, and income tax expense. So I know that I'll need to credit all of those accounts to get their debit balance to zero. And then I will need to turn around and debit retained earnings. Again, that will decrease retained earnings. And we'll get a total here in just a moment. So I have wages expense, and this is just the kind of tedious part, going through and get rid of all of our expense accounts here. Depreciation, and that is in the amount of $1,300. Then we have utilities, $4,220, $1,400 for insurance, $6,000 for rent, and $2,900 for income taxes. So I'll just fill in the names real quick here, and I'll abbreviate. There's utilities. 1,400 was insurance. 6,000 was rent, and then our 2,900 was income taxes. So I can get a sum of all those amounts, and that will be my plug to retained earnings. So a debit to retained earnings for the total of those expense accounts, $37,420. And that's it for closing entries. Again, closing out all of my temporary accounts, which are revenues, expenses, and dividends. If we get stuck and we're not sure what's temporary, we can think about our balance sheet. If it's not on our balance sheet, that means it's temporary, right? Balance sheet only shows our permanent accounts. So again, typically I book a closing entry for each of those three types. One for dividends if I have them, one for my revenue accounts, one for my expense accounts. It's not necessarily critical. We could combine them all into one if we wanted to. Certainly not a big deal. As long as we have them in the proper order and the proper amounts, everybody can go home happy. And that's it for 417.